So here is how you're going to approach the situation in your business. You are going to compute your potential revenue, and you're going to compute your prices adjusted with inflation. You're going to take the average percentage inflation. You're going to get any number between, I would say, 4 to 6%, because we're printing more money right now. Federal Reserve is printing more money right now. So you need to understand that when you take this average percentage interest between 4 to 6%, and you apply this spread out through the next 4 years, you will get the number that you should actually use, increasing the prices every quarter or every couple of months until the year of 2030. So when the year 2030 comes, you can keep your clients, you can keep your revenue, your buying power will be the same because you adjusted the prices with inflation, and you effectively didn't lose any clients because people used to having these small price bumps here and there. What will happen with other companies? They will be forced to increase the prices overnight. So what is going to happen? Well, when you increase the prices overnight, everyone will churn. Over 60% of the clients will churn. If you used to charge, let's say $10, and you wake up in your business and you understand inflation has rose for the last 4 years, let's say 12%, and you have to increase the prices of your goods and services with another $6 or $7, you do understand no one was going to buy. Maybe it's very slim, small percentile of people who really do not make any difference, do not see any difference between $10 and $19 or $10 and $18 will keep buying. But this won't be enough for you to cover the cost and the labor and whatever, right? The math will not matter at this very point. So after we solve this issue for your business, how you're going to adapt your personal spending, your personal expenditures? Well, presumably everything that you usually buy, clothes, accessories, vacations, absolutely everything will be more expensive. There's no world where things are going to get cheaper, especially on the commodity side. Commodity side is everything that is actually physical. Hats and glasses, clothes, merch, whatever. Why? Well, so far people had money. Inflation was kind of in control. But now with all the war spending, the inflation has gone out of control. So printing more money was required for keeping up with the war activities. So why this changed the math? Well, when everything got so expensive and when the money started losing faster and faster their value, people stopped buying as much as merchandise. So all this fast fashion, cheap shirts, cheap pants, they stopped working because they don't produce. The company cannot use the economy of scale anymore. So the company cannot produce 100,000 t-shirts a day for a cost basis of 74 cents, right? So if they cannot produce 100,000 shirts, do the math. They have to produce 50,000 shirts. So the cost jumps double. So if they produce 74 cents a shirt, and now if they can produce only 50,000, so the cost basis jumps double. So 150 a shirt. So they cannot sell the cheap fast fashion anymore, right? Do the math. This is just figuratively speaking. We're not, using hardcore data. But just on the numbers, this is exactly how it works. And this is why the economy of scale for all these fast fashion brands and even the luxury brands which rely on premium will not be as effective. I'm expecting to see, listen up, this is a very large speculation, but I'm expecting to see more and more people actually to start stocking up luxurious brands. I'm talking about high quality premium. I'm talking about cashmere coats. I'm talking about baby alpaca coats. I'm talking about, probably some of these females, purses that are limited edition. I'm expecting people to actually store value and exchange their money for some of these physical, limited edition, in high demand goods. Because this is definitely some way of, I would say, leverage and hedge against the market uncertainty. Because in the AI bubble, it's still 50-50. You still know, is the market going to bust or is the market going to continue running, right? We still have more tech companies report earnings later this month. So pay very close attention. This is my largest and biggest speculation. I personally have purchased a couple of, I would say, relatively expensive clothing. Not for myself, I just exchanged. I sold a bunch of other, mid-tier brands and bought one very, very high-tier brand. Not for me wearing it on the streets, but me just keeping it as investment, because I know at any point in time I can just liquidate the item and extract much more cash. What I'm saying, let me simplify. Let's say I have 3 different P codes, right? Or just random brands. Let's say some mid-tier brands, whatever. And so each one of them, and with the purchase, with a budget, selling these 3 different P codes, I bought, European code. Something like this. Exceptional difference between the liquidity of these expensive brands holds value, and it's easily, you can go and, I can go tomorrow and drop the code at the pawn shop, right? And I can get 400, 500, 600 cash on hand. You cannot do this same thing with mid-tier brands. No one cares. Yeah, cool jacket, man. Yeah, I don't want to buy it. Because there is something else, except the intrinsic value. There is something attached to the longevity of the item. It's not just quality, it's not just brand, it's the value proposition. So keep this in mind. This is probably one of the biggest speculation, but something to keep in mind, okay?
This is exactly what people said who lost money on silver during the 2000s run-up of the silver. People were frustrated, people were extremely angry that they purchased at the top. Later, after they call it a bubble, a lot of people actually said it's actually a scam. Read very carefully. Based on the market analysis, people who purchased at the absolute top of the silver at this time, around 2000s, they had to hold over 20 years just to break even last year. Pay very close attention. Based on market analysis from the era, people who bought at these particular prices were experiencing excessive frustration at the times of irrational sentiment-driven nature of the market rather than just supply issues. While some believed in a long-term value, this sounds familiar. A lot of people now in the comments, we're here for the long run. While some believe it's a long-term investment, others face losses from the rapid price crash. What about sentiment? Well, back then the sentiment was, of course, over the supply. Everyone was bullish. No one cared about the actual intrinsic value of the silver and long-term price action. Observers noted that in the early 2000s, like the dot-com bubble, silver price movements were driven heavily by investor feelings and speculative frothy sentiment. Same like now. People are buying because other people are buying. Unwarranted. I'm here to warn you, okay? It's not gonna be like the other time. Investors often found themselves in position where they had bought into a runaway speculative frenzy that was not supposed by fundamental supply changes. Guys, when there is no fundamental at the exit of anything that you're buying on the equity markets, on the precious metal market or crypto markets, the exit is usually always the same. People got rinsed. And in the case with silver, like I said, how would you feel if you have to wait 20 years, your money locked on losses just to break even, not to make money? I guarantee you there will be, or there had been people who last year just broke even, waiting this 20-year period, and they didn't even want to think, oh, it might go hard, I might actually make some money. No. Let me just sell. Let me just, forget about it. I've been waiting 20 years. I don't want to hear silver anymore, okay? Look at this. Volatility and the crashes. Even with the potential for long-term growth, something that a lot of people now are buying into, the main reason for it, those holding silver in the 2000s faced significant volatility, such as major rapid and historic crash. Of course, there was frustration with physical disconnect. Some investors, particularly when holding silver, trust during the volatile times expressed frustration regarding the disconnect between the paper silver prices and the actual physical supply of the silver, which is happening as well right now. If you go and look at the exchanges buying the actual futures or actual silver on the equity markets versus holding the actual assets, physical gold and silver, have different prices, have different value, right? And this is the same frustration. Why? Because the game is always the same, but the newcomers don't know this, so they're gonna get rinsed again. Pay very close attention. In summary, those who lost money often cited an irrational bubble-like behavior of the market and high-risk speculative nature of trading silver during this period. Again, you need to understand what is happening by looking what actually happened, because the same people are trading the same stuff and they're buying into the same stuff by looking at hype, irrational thinking, sentiment, which is oversupply, which means that the sentiment is overtaking the supply, the actual fundamental value. If you're trading, you know that if you look at the RSI index, right, it shows you oversold, overbought, and you have the fair value, which is the fair market evaluation of the asset. People are not looking at any of these. People are just looking, okay, is it up? And people are always willing to buy when it's up. And most of them are willing to sell when it's red, which is completely opposite, right? It almost feels like you're willing to buy your home when your home, like, it's $150,000 more expensive than last month, right? But if your home that you're planning to buy, it's $150,000 lower, you're not interested in buying, because you were thinking, first of all, it might go lower, and second, you might be thinking, oh, it might actually not be a good deal. If the price decreases, if I buy it, it will go lower. So it's a two-way think about it, right? First of all, you want to go lower so you can buy it, but you don't want to go lower because it might actually be a bad deal and it will depreciate, or it might depreciate even lower after you purchase it. So it's crazy checkmate scenario. And of course, it all ends up with volatility, crash, and frustration. Same three scenarios. And this is not me making up anything. I just went on Google and I just typed, what did the people who lost money trading, holding silver in the crash of 2000 said about the crash? That's it. I just asked Google for summary. I'm not making up anything, okay? This is proven by the facts. As you can see over here, everything comes from a particular link with comments, summary, articles from 2000. And people got rinsed. Imagine what they came home, you know, what they said to your wife, you know, it's down. We put 100K, now it's 20K, it's 30K. I'm sorry, I apologize, right? They have no explanation. You know why they don't have explanation? Because they don't have reason to buy into it in the first place. When you have a thesis and when you have a sophisticated framework to define your thesis, right? Why you buy Nvidia? You have a sophisticated explanation. Nvidia supports the AI infrastructure, which AI infrastructure cannot exist without Nvidia. Well, Nvidia presents a bottleneck through the industry that is evolving and growing on the institutional or individual level. So this is how you build your thesis. This is how you understand the main reason why you buy into something. If you stop some of these precious metals bulls on the market and ask them, why did you buy? Now or before, most people have zero answer. Zero answer. They will most likely pull out their phone and they're gonna show you some video or something or someone that told them to do so. The question is, when everything crashes down, right? What they're gonna say? Are they gonna go again and back and look into this person, ask for a question, for advice? No. Because it is not bad to lose your money investing if you really put up the time and work and you predicted something is going to happen. You may be wrong, but you lost or you made money based on your own knowledge and expertise. It almost feels like an achievement because you put up the work, you test something with your own money. You don't use leverage, you don't use someone else's money, you don't use your friend's money, you don't listen to somebody else on the street. You just took your own money, did your own research and due diligence, and then you waited to see, is it gonna be a success or is it going to be a failure? This is how the man should supposed to approach everything that appears to be an opportunity, or it might end up being a trap. Gold and silver prices crash in historic sell-off. Gold prices to hit new lows of $1,450 and silver to go down to as low as $12 per ounce. Well, this is how you print back holders in real time, but we already discussed this in the previous video. People already pissed off, probably crying their eyes out. They borrow money, they use leverage. But who I am to argue with the hype boys on the markets? Let's stick with the details. So the spot prices of silver down 28%. 28%, what a sell-off. My little free end, and people were making the case that the precious metals are not stocks, are not crypto, are not the US dollar. They're valuable, they are not fluctuating, they couldn't go down. Nonsense. So the prices was hovering around $83, currently it's even lower per ounce. Not a surprise, you don't have to be, excited because things are going to get even worse. According to the summary over here from the X, this is, or this was, and most likely it's not going to be, the worst single day drop since 1980s. And all the backholders of silver who held over 20 years just to break even, already having a small reminiscence. They already remember that, oh my gosh, last time what happened, it might happen again. And believe me, if these people went through this particular crash, they have to hold their silver bags for 20 plus years just to break even. They're going to be the first ones selling right now, seeing weakness on the market, not waiting another 20 years to break even again, right? Forget about what Peter Schiff and the people like Peter Schiff saying that this is a buying opportunity, this is that. Same thing what Robert Kiyosaki was mentioning, that this is going to be the biggest crash of our lifetime, and this and that, and buy Bitcoin. And what was it, November or December, somebody reported that he sold some Bitcoin. Don't ask me why, ask him why. Also, over here, the sell-off was followed by President Trump's nomination for the Fed, which was Kevin Walsh. Which, why would that be even the case? Why people be reacting like this? Well, this is acting like this because the US dollar will again go back to the previous levels and will sacrifice all the gold and precious metals price action because the dollar will regain its power. What a bad news for gold and silver investors, but even worse news for BRICS, which in fact launched just 2 days ago their new currency called UNIT. If you're not following the international economic news, I honestly believe it will be very hard for you to follow up and really match the pieces, but this is a very strong checkmate move from President Trump because now he's seeing what is happening with BRICS, and BRICS was trying to capitalize on the weak dollar, trying to capitalize on their gold and silver reserves, trying to build their wealth, country wealth, and their hedge. Because, let me explain, the new currency of BRICS called UNIT is 50% backed with gold and 50% is backed by basket of currencies of the countries in BRICS, which trying to make it less volatile, trying to make it in some form or shape at least copycat of the early dollar gold backing before or after Bretton Woods, which, don't take my word for it, it most likely won't work. But anyway, let's go back to the facts. Kevin Walsh is very, very bullish on the dollar, and Kevin Walsh will create much more value and much more contribution and intrinsic value for the transacting in US dollar. Will most likely reduce the Fed exposure to gold and silver will most likely create a long-term cooling off the precious metals, and this also might trigger actual oil prices to hit new lows. Just wait for it. Again, the losses today alone totaled $3 trillion to $7 trillion across both metals alone. We're not even looking into the smaller precious metals market caps in the sell-offs like copper or palladium. Things are gonna get even worse over there. Not to mention the liquidity over there is much worse. So this simply meant that there's a very high chance a lot of people who try to sell weren't able to get filled on the prices they're trying to sell. And again, if you if you have a basket of precious metals, if you're a precious metals bull, someone that is forever and in the future is only going to be the precious metals, forget about stock market, you do understand that these people will be panic selling first of all this type of precious metals. The ones that with the lowest liquidity, the ones that is very hard to exit. It's easy to enter, everyone is willing to sell you their palladium, their copper, but it's very hard to sell. Why? Because there's not a matching buy order on the opposite side of the equation, and also there is no market making on the precious metals. So there's no a market maker who is forced to buy when no one wants to buy, or forced to sell when no one wants to sell. Again, people don't want to listen. People are extremely arrogant. They argue. I've seen people arguing with Ray Dalio, with Warren Buffett. I've seen people, especially in these financial news channels, having zero achievements in any financial markets and arguing with these legends, right? So I'm not surprised people will still be arrogant and still will be claiming that they know more about the market, they know more about gold, they know more about silver, and they never get rich. I don't know how this works. If you know more than the biggest OGs, if you know more than the billionaires, if you know more than individuals from Wall Street or financial markets or private equity funds, well, then you most likely has to be wealthier than them, but you are not. So I guess this destroys your thesis in real time. Anyway, crypto market also suffer. We have to put everything on the table, right? We're not excluding the Bitcoin sell-off below 82,000, but that's not a news. Remember, we had Bitcoin around 80,000 in November sell-off. I made a special recap video where in 2025 we only had 3 good months for crypto. It was March, it was August, and it was September, and everything else was complete garbage. Sell-offs, chop, sell-offs, and completely die out. And now we're having this, widespread liquidations. But like I said, this is not a new news for crypto. This is not new news for tech sector, considering the yesterday's earnings, very mixed reaction. Microsoft overspending with not clear roadmap in the future. Only Meta benefited because the benefit of Meta using AI, collecting more money from ads, and Meta ad campaigns are very profitable. Meta also did the partnership with Ray-Ban, which in fact somehow became successful. I was very surprised. The product looks very ugly. Like the V1 version 1 always is like, not so perfect, not so polished, but I guess people like it. So most of the market crashed today. We are going to be honest, but nothing of the silver and gold bulls was not expecting to happen. So this is why we have to point out this, we have to highlight this, and we have to give them a red card, right, for not being experienced or knowledgeable about the markets, expecting that only silver and gold will continue and persevere all and every market crashes. It's funny, it's ridiculous, and these people should have the reality check, not only from me, from the market itself.
Many people are not ready for the crash that is coming in gold and silver. Why? Because they lack historical context. A lot of people thinking that the prices of gold and silver will continue to go higher and higher without having the drawdowns and drawbacks. But why this is important? This is important because a lot of these people have lack of sufficient historical context and knowledge about the markets. In 2006, the price action of silver mimic identically the 2026 small pullback, small sell-off. The parabolic surge in 2006 of the price of silver led silver to go to $15 per ounce. Everyone was cheering. People were preparing for $100 per ounce. What happened? This price action followed by 40% plunge. 2006. Why this is funny? It's funny because we had 40% crash 2 weeks ago in silver. The problem is that if you again go back to historical context, the silver didn't end up there crashing the price. Silver actually went lower. And the problem was that people have been holding and sitting on losses for 12, 14 years. How are we gonna feel about it? Instead of you making the right decision, instead of you picking or hedging or limiting your risk, you sitting or staying on loss for X amount of years, and you're not only sitting on loss, you are into something known as opportunity cost, meaning instead of you making money of something else or being able to bet on something else, you're locked sitting on your losses, can't do anything about it. Again, people have a very hard time understanding the concepts, and this is why the parallels, because you need to make a parallel between the past and the present, helps you understand and gives you better, not the best, but better chance to what could potentially happen with your portfolio, with your money, and the prices of precious metals, right? If you look at closely, in May 2006, silver skyrocketed 80% from $8.50 amid the, again, retail hype, same people, the usual crowd that is involved in hyping particular asset class. ETF launched SLV. This was another hype that contributed to the bubble. Also, we had some kind of industrial demand narrative that there will be more demand for silver, right? Remember there was like an EV, the beginning of start speaking out loud about electric vehicles and battery, which use a small amount of silver as well for the production. That moment, silver hit $15, just like the 2026 when silver hit 72 and later $121. The problem is that this was a bubble, and the bubbles are bursting. That's what usually happens, and that's what their lifespan looks like. The bubble never stays at the same size. The bubble never remains inflated. The bubble bursts, and a lot of people don't want to hear about this. So look at the parallels, right? We're talking about things that have already happened. Pay very close attention. We're not coming from some, figuratively speaking, Marvel movie scenario. This already happened. So you have nothing to argue, nothing to talk back. This already happened. So open interest in silver exploded, positions turned crowded, and momentum ignored deficit. Exact replica of 2026. We're talking about $3 billion plus ETF inflows, which indicates a lot of people with, let's say, mid-size net worth that use private banking. They call the bankers buy silver, the bankers bought through the ETFs, BlackRock, Vanguard, whatsoever. What happened then? Well, it was painful. The crash mechanics actually were triggered. What happened was that there was a new Fed chair. Oh, surprise, surprise, we do have a new Fed chair coming in May here. The Fed actually changed the interest rates. That back then it was Ben Bernanke was the Fed chair. What he did is what most likely Kevin Walsh, the incoming Fed chair, will do, which is he will increase the yields on treasuries, which will make it more attractive. People will say, oh, you know what? Instead of holding this, I can hold this, have a risk-free investment, and just chill, right? Get paid even more. So Ben Bernanke increased the yields, which led to the dollar index, which is DXY, exploded. And when dollar explodes, you know what happens with all the leverage position of every asset class that is in contra sentiment with the dollar, gold and silver, trigger massive liquidations. The idea over there that everyone who was long using leverage on gold and silver got liquidated, they lost their entire capital. And then people who were smarter, who used their own funds to buy hold silver and gold, they were like, you know what, this thing is not looking good. I'm going to exit and I'm just going to buy treasuries. They look at the market was kind of flickering, didn't quite give a direct signal. You cannot really go directional trade. You don't see, are you going to go the market lower or higher? Let's just go safe. And they went into treasuries. The strategy of the Fed chair worked perfectly. What this actually did to the prices of precious metals, 40% drop in silver. overnight margin call liquidations. People freaked out. That was the end game. Still, there were people hyping, saying, don't worry, guys. It will go back up again next week. Next week was 14, 15 years people waited to break even, not to make money. What a bad trade, man. Life is unfair, someone will say. The liquidity evaporated, disappeared. This is why when now I'm explaining to you and I'm showing you the data indicates that there is a very thin liquidity in precious metals, which means it is easy probably to buy in because there's always somebody selling, but it's hard sometimes to get your sell orders go through. Why? Well, you need a matching orders, right? Remember, there is no actual market making that helps you to indicate this. You don't trade this on the exchange. This is essentially a decentralized market similar to Forex, where the Forex works when investment banks work, right? This is why the transactions are different, the spreads are different, the fees are different. On Forex, you as well have to pay an overnight fee for holding the pair of the currency. So you need to understand this is much more complicated than other people think. They just see the surface, they just see the packaging. They don't understand what is inside, and they don't understand how the value of what is inside can go very, very low and can stay low for a very long period of time. But like I said, people lack historical context because people are lazy. And when people are lazy, it's easier to speak out loud nonsense. It is easier to talk back instead of sitting down. It's weekend, let's open, let's look how much money we invested, let's see what is the forecast, let's see the moving averages, let's see what the analysts are expecting, let's see are institutional investors increased or decreased their current holding, right? Let's create a plan B or C. Let's see if the Fed chair actually repeats what the Ben Bernanke did, what will happen if I lose money, what I'm going to do, when I'm going to cut my losses. So many good questions that people do not really ask themselves, which is the biggest problem over here. Let me tell you about startup idea that is in huge demand, but no one is building. It has to be a new social media platform where broke people are not allowed to comment, essentially the haters, right? So it has to be a technology where every user will connect their, net worth, bank account, portfolio. The system will validate that these people actually have credentials to speak on behalf of certain topics, give suggestions what is right or wrong. So broke people will not be allowed to comment, right? This is the huge in-demand social media that will become the future. You no longer will see clueless people speaking from in the middle of nowhere, broke losers commenting, oh no, you're wrong, this or that. They're trying to give, their opinion. No one asks them about their opinion. They're trying to give you their perspective. All of the tech bros watching this build a social media platform where users will have a chance not only to validate their net worth, their credentials, their expertise, their success, and their track record, but also you will limit all the bots. There will be no bots, all the haters, all the broke losers, all the paid shills and people who haven't done a single entrepreneurial venture. Successful or not, entrepreneur is entrepreneur, successful or not, right? Regardless, you take risk, you put your own funds, you hustle. So then you will have the most valuable company in the world, because when the advertisers show up, they know exactly who they're advertising in front of. Okay, this video has 1 million views. All the commenters are sub $300 million net worth. You know exactly what to offer. Imagine what kind of brands will show up trying to run ads on your campaign. So you effectively don't need so many users like YouTube, Facebook, Instagram. You just need to have the high life on your platform. The real rich people, not the people who are flexing, not the people who are pretending, not the scammers, not the losers, not the bots. So Tech Bros, this is the platform you should build. So when you publish a content as somebody who is expert in their field, and when you sit down and read through the comments, you said, you know what? This person is actually right. He has made, $150 million more than me in this particular business. Let's say I speak about gold and silver, right? And somebody said, you know what, I made, $45 million last week. I'm gonna show you how to do it. I said, fine, let's see each other. Let's talk about it. Let's have a Zoom talk, right? This is absolutely amazing and most valuable potential social media, because every big fish will want to be part of it. No losers will be accepted, no scammers will be accepted. Everyone will be vetted, and they will be created a massive value for every participant on each side of the equation: the advertisers, the content creators, and the founders themselves. By 2028, 81% of the people will be replaced by AI. It's okay, right? You already know that, you already expect that. And the biggest lie that people are trying to sell you right now is, calm down. AI will create more jobs, it will not replace you. You know what's funny? The same things were said to the people who were building carriages when Henry Ford was building the Model T. They were saying it's okay, the new cars, they will not replace you, they will just create more jobs for you. I don't think it actually happened, right? Exactly. So knowing this part of information, you need to start preparing yourself, because the only people who will be left, this remaining 19% of the workforce, will be the geeks feeding the AI, the super intelligent streams, the super geeks of the world. Someone recently said that this is the decade starting 2026, the decade that is named the revenge of the geeks. So all the people who will actually be happy throughout this decade, will have fun, will make a lot of money, will be the geeks, So this is why you want to pay very close attention. And this is not the Andrew Tate matrix. This is a completely different level in which, even if you try to learn something right here, right now, the information is changing and develop so fast that all the knowledge that you're acquiring today, tomorrow, it's an old story. There are new models every single day that are released, some of which sometimes are worse than the older model. And you will see the geeks are saying, you know what, we prefer the older models, the new model sucks. This is the big red flag that you want to pay very close attention to, right? Again, there is no way back, considering that the infrastructure for hundreds of billions of dollars is currently built, or is building, or is about to get built. $500 billion, $1 trillion, data centers, so on and so forth. And this is kind of interconnected with all the precious metals trade and proprietary natural goods and resources. A lot of countries, particularly China, are trying to curb down and try to protect their intellectual property. And again, don't be just saying that a lot of these models are operating on expensive sites. So people said that the Chinese models who are copying the US models are actually operating faster, more optimized version, and this is again a big question mark. I'm not a geek. I don't know why this works better, but there's something that we don't really know. Pay very close attention. Every single day, the people who are currently fired from the big companies are not the HR departments. You will see engineers, senior engineers from Google fired, senior engineers from Microsoft fired. You will see financial institutions firing people. And we're not talking about data entry positions. And then these people go on the open market and they're not gonna go and drive for Uber, right? Senior engineer work 10, 15 years for these big tech companies. Well, they're gonna start their own AI company. This is where the mass saturation comes into play. And imagine, it's not you against the big technology corporations, it's you against the corporations, the geeks that work in corporations, and then the geeks who are fired from the corporations starting their own AI companies. So the wave is not that high, the wave is like triple the size that you can imagine. A lot of people don't even think about this, right? This is why the conceptual wisdom that probably you want to build and understand and try to apply, because you have what? It's 2026. You have 2 years, brothers and sisters. You have 24 months to find something out that will be able to kind of put you on the side. Sure, there will be areas of business, domains of life where the AI will simply not gonna be able to evolve that fast. The barber will still be out there, right? Not sure about the other utility workers, but remember, they're not doing all this replacement because technology is just better. They're doing it because it's effective. It drives the cost lower, makes things effective, cheaper. This is why Elon Musk is saying that in the future, when the robots taking over, everyone's gonna be rich because no one has to work, and people will just enjoy the good times. And I don't think so. Yeah, not hyped about the robots either. So guys, just as much as I know, a lot of you probably are not into technology at all. They're not interested. They don't really care. Understand? I get you. It's kind of a forceful part of the history where a lot of people are forced to learn something that they don't want to learn. You kind of forced to at least probably take a position or learn a new skill in area where you really don't feel it. It's kind of an artificial knowledge in the AI world. But this is something that obviously will make companies more and more profitable. And the profits are always the most important driver out there. Everything is done for profits. Countries, governments, states, and cities, they all operate under the same goal, which is state to progress, to make more money, not to spend more money. And the idea over here is that this will replace a lot of jobs. And employment is one of the biggest lever that costs a lot of money. It costs not only money, it costs liabilities. You have healthcare for the workers, right? You have special plans, you have retirement plans. You don't have to really agree with me. You just have to read, if you can read, of course. Klarna currently replaced 700 customer service workers with AI. Duolingo cut completely contractors' work, which effectively means that all the bad customer support call centers overseas will also be replaced very, very soon. People will no longer complain that, you know what, I call up my bank, someone pick up the phone, your kids crying around, I don't know what the heck is going on. So this is also going away. Moving on, IBM completely paused hiring 7,800 positions, all of which will be replaced by AI. They said we're pausing hiring. Meanwhile, they already hired the AI agents doing the job, getting the job done. They just don't want to say it because they don't know how to say it, you know. Soon you will see a lot of departments simply disappearing from these big tech companies. Moving on, there is something that no one actually talks about. It is not just that people are getting fired. There are no jobs listings. And even if we see jobs listings, companies are using AI to filter, vet the jobs applications, and effectively people from one side are using AI to create CVs and resumes, and from the other side companies are using AI to review the AI applications, which is absolutely crazy, funny, and in some way pretty sad, because the same leverage the employees are using is actually being used against them by the employers. It's comical, ironical, but actually true. Look at this. There are currently so much advanced AI tools that people who have been studying very, very hard, who have been accumulating very important skills for the last couple of years, are currently no longer necessary. There are apps that can code the entire application, and I'm not talking about the apps that you already know. I'm not talking about taking scripts that are not working, scripts that are essentially need at least 2-3 actual engineers to review the code, fix the code, on the privacy side issues, on the actual functionality. No. I'm talking about extremely sophisticated AI applications that can build a full-fledged code that actually works in an enterprise level. We're not talking about the small size, my university, your university, social network type of shit. Also, junior positions are simply disappearing. I can't remember, I might be wrong, which bank, but they simply said that certain junior positions will simply disappear because the job of juniors is simply useless, pointless. They don't learn anything. The bank doesn't get anything from them at this particular level of the hierarchy, right? So they effectively give them some money before, get them as junior, just to make sure that no one else hires them. Now they don't need to do so because the AI is doing the junior job. What this means? Well, this means that the first hiring will be for the next level. But the people who are graduating, they don't have the experience either through internship or junior positions. So if the junior positions disappear, if the internship position disappears, how these people are gonna get any type of experience? I have zero expectations to see anyone getting any experience whatsoever. This means that there will be a major gap between people who are graduating and people who are getting their first job. And first job might be, well above entry level. All the entry level junior positions might effectively be replaced. Maybe some of the mid-tier as well. Look at this. Junior lawyers, accountants, graphic designers. We all know about the graphic designers, movie producers, script writers. All these people positions, unfortunately, are already in the past. And this is kind of good, kind of bad. Why? Because the people from the creator space are very artistic, very interesting, but they work slow, right? If you order someone to write a script about the movie, it might take years, right? But the AI can write a full-fledged, very good, sophisticated on 17, 18 different tries, probably very good, well-written, interesting, clickbaity movie script for, a month probably. Which speed always is a good thing. Now you can see even the real estate development projects are building so fast. Especially I see here in the city, I see a project begins maybe in August or July. Now it's already fully ready for tenants. It's unbelievable. It's like 5-6 months. You have a 50, 60 story building, complete, ready, everything. Outside you have the windows, you have the entrance, you have everything, the foyer. It's crazy how fast these people are actually building. I don't know, is this in some way, AI help to speed up the process? Maybe the architects, using AI, I don't know. There's some architect, someone in the industry. I will be very interested to read more about this. Do you know that average person loses around $10,000 per day scrolling on TikTok? I genuinely believe, I'm not exaggerating, we're going back in history when the society was divided by kings and peasants. I don't see how the income inequality problem will be solved. So a lot of people who are currently experiencing misfortune, they were fired, they couldn't start business or couldn't find job, I genuinely believe that things will not get better or easier. And this is not your mistake. It's just how fast the world is moving and how slow the people are adapting to these changes, right? And I understand. I can empathize why so many people don't want to learn AI. Because you're not geek, right? You're not geeks. You don't really care about this software, these changes, these systems, these AI agents. You don't really care about automation. You just want to chill. You just want to have your secure job. You have to have your very expected earnings this year. You want to know exactly how much taxes you're going to pay, when you're going to get paid, etc. But life has become very, very busy. This is why you will see the concentration of wealth is increased. You will see that usually, I have all the collection of Forbes magazines since back of 1989, 1980s, right? So I screw all of it. So I essentially read how the whole generational wealth has moved from one person to another. And every couple of years, you see different people are appearing in top 20, top 50, top 10. But for the last 5 years, the same people have remained on top. And these people are not losing their spot. Instead, they're actually getting wealthier and wealthier. What this means is that for the first time, we're having the same people are not losing their spot, they're not getting less wealthy, they're not retiring and moving away from business and somebody else which is currently more active replacing them. But instead, we're seeing the same people actually double down. Elon Musk doubled down. The person who owned all this, the French billionaire who owns all these fancy brands, right, fashion brands, he doubled down. He didn't retire. And if you look back, the people who were wealthier, let's say in 2000s, Bill Gates, he retired, he stepped down, somebody else replaced him. The guy who owned Zara, he was the richest person in 2003, 4, 5, right? He stepped back, he scaled down operation, he focused on his life, not so much to business, right? There was a Mexican billionaire, right? He was also 2-3 years every time, first place, second place, third place. So you always get some switch. This year we had Larry Ellison from Oracle. For 1 day or 2 days, he was the richest man alive. But the concentration of wealth is in direct correlation with the AI development and how the economy is more and more related towards the technology. If before some portion of the GDP or the gross domestic product or the infrastructure or the businesses started in particular niche was kind of divided more or less equally. You had a lot of people starting and working in real estate, being on the developer side, being on the sales side, and also you got a lot of people, a lot of services that surrounded this business. Then you had a lot of people who were working in normal service jobs, right? People were happy. A lot of these jobs, little by little, especially now in 2026, will disappear. A lot of which already are gone in 2025. So this led a lot of people to adjust. The only decisions that they could do is to adjust. And adjusting is not easy. This is why, like I said, if people do not adjust, do not learn, they will be left in an old system where there were kings who had all the material possessions, all the power, they made the rules, and everyone else who didn't have all that, who didn't adjust, who didn't build his own small empire or small kingdom, or who didn't relocate elsewhere, he stayed at the same exact spot. Well, this effectively meant that the world back then was divided by kings and peasants. And if no one in this current environment, economic system, don't want to learn the new skill, like I said, I'm not judging you, not forcing you. I understand how annoying it is to move from your whatever you was doing prior to go online and start learning all the geeky stuff, all the different chatbots, all different systems, what kind of softwares. Not to mention that there is a bunch of hacks that are currently reappearing. The systems are reinforcement learning, and also the hackers are utilizing all the noobs who are just beginning to learn all these systems. So, not overhyping, not over sensationalize the situation, but if you expect things to go back, you're in a bad luck, because the corporations will like the savings on the employment side. The government will like the speed of how job is done. Everyone, usually who receives service that before was taking a couple of months to be done, now it will get very, very fast. If prior, let's say on the simple framework, let's say you buy a home and you have to change titles, and if the old model will require manual checking all the history of the property, now the AI will pull up the files and will do evaluation and will do all the necessary stuff probably in 1 hour. Like, this is the positive side, right? All the I'd say very human consuming and pretty manual work will simply be limited, which is kind of a only benefit you can think of. Question is, will the life become cheaper or more expensive if we exclude the actual inflation money printer. And so if we just focus on the AI automation, this is what a lot of people are talking about, universal basic income. But when you think about it, right, if you start with certain amount, 20,000, 30,000, 40,000, people will want more. And every single year they want more. It's almost like these pensions that people receive in Europe, where for every holiday you get a bump on your pension. Like you have Thanksgiving, you have what was it? I forgot what was celebrations in Europe, but for Christmas they got bump. You got additional money on top of your normal monthly allowance from your retirement. And this particular system is designed to adjust on an annual basis with the rate of inflation. It's called the Swiss rule. So I don't really see the solution over here unless everyone gets at least on a basic operational level knowledgeable to use AI, and then the life kind of can keep moving forward in the same system. Because I still see people, you know, during the week waiting on the ATMs to deposit their pay, right? It's crazy. People still wait on the ATMs. Like, you don't really get paid with the checks, so you can take a picture and deposit your money. It's really outdated systematically. A lot of things have taught a lot of people to live in the same way for a very long period of time. No one has, in fact, taught them that things could be done differently. And innovation, and the last adopters of innovation usually is the people who are losing the most. The people who are last to decide, okay, I am going to learn AI. It's already gonna be late, G. Average person spends around 2.5 hours per day scrolling on TikTok. That's around 912 hours every single year. And that's enough for a lot of people to change professions, obtain licenses. They can become pilots, they can become dentists. You can change your life, but instead people are actually scrolling on TikTok. Let's run even more numbers so you can understand the concept over here. Not realizing why so many people who are scrolling and brain rotting all day, every day are actually the most broke people out there. Don't tell anyone. Look at this. If you just spend one of those 912 hours per year doing something else, you can go and enroll in pilot's license. You can learn how to fly the seaplane. You know, these planes that land into the water. You can go and obtain the private pilot license. You can go and obtain a captain's license. You can buy a boat. You can learn how to sail. You can learn how to ski. You can become a ski instructor. There's so many different cool things or professions that you can actually learn. Not seeing so many people complaining and crying over here on TikTok, on the feed. I got fired. I submitted so many applications. No one is hiring me, because people applying for the same fucking job. Guys, you have to look someplace else. Obviously, this position, this job, this industry is finished. AI has taken over. Second point over here. This is just 1 year. What if we go and multiply the same exact years for, let's say, the period of 5 years? You can definitely become a lawyer in 5 years instead of spending time scrolling. Not to mention that there's some people who claim that in California you can actually become a lawyer without going to school. Someone said that. Don't quote me on this. But the main concept is that people learning the basics. A lot of people before just go home, go on Netflix, Disney, whatever, used to watch particular shows, series, go to sleep, and rinse and repeat. Now a lot of people work all day, they go home, scroll on TikTok for like 2-3 hours. Maybe while they're making the meal, during eating the meal, probably even after the meal, they keep scrolling and they spend a lot of time for entertainment, which I understand. Sure, anyone from time to time needs to spend some time, watching some crazy nonsense, bullshit content. But a lot of people spending the full time online doing this. And here is the $10,000 example in which we started with. This is not coming from thin air. We're not coming up with numbers over here. we're not only losing the $10,000 a day. Effectively, it's $348,000 over a decade. And that's maybe half house, maybe down payment plus some other if you live in more expensive area, or maybe you can buy a full house if you live in an area where houses are not so expensive. And just think about it. Some people are losing more money at home scrolling than they earned throughout the day on their day job. Look at this. That's, if you break down by day, you effectively could be losing around $95, which, depending on the person, how many hours, some people spend more than 2.5 hours. The calculations were based on 2.5 hours, which is based on study. So if you spend more time, you actually lose more money. If you spend less time, you lose less money, which again kind of makes sense. And this is why probably Gary Vee is pushing so many people who are already on TikTok just to go out there and start, this tele-shopping business, full-time live shopping services, which honestly I don't support. But if you spend your time on TikTok anyway, you might as well make some money out of it, right? At least you're gonna reduce your losses over here just by judging time spent. But again, it sounds crazy, but the opportunity cost, which is doing TikTok versus anything else, is compounding. Think about a friend or someone who you followed online, or some of your colleagues who started a business after the virus situation. This is like what, 5 years ago, 6 years ago. So this time spent, you not taking action versus the person that who took action, who started a business, or who changed careers, or who become something that they weren't prior the virus situation. It's the opportunity cost, and the opportunity cost is much higher than the cost of taking risks. The cost of, people usually said you have some savings, right? The right thing is to protect them and not taking risk, or be very careful, because this way you're not going to lose money. Not saying that doing nothing with your money, just being in the bank, you still lose money effectively. So this is something that you should think about. In action, it's also in most cases wrong decision. This is why it's so complicated. People usually pretend to be the binary choice between two options, one of which always going to be the right one, and the other one always going to be the wrong one. And that's completely wrong. There's so many different options, and one of these options might fit more towards your final goal, and the other one might fit more towards something else. Let's say you want to become rich. That's why you go to study economics or business or finance. That looks like a right decision, right? But then halfway through you realize, I can become rich by doing something else which I like more. So the first decision that appeared on the surface to be the right one and will be the one that will get you to the end goal was not the one that you actually end up taking. And this is something that a lot of people do not understand. There are many ways that you can get things the right way, and you can screw your path to success in many different ways. How many people have essentially ruined their careers by just making the wrong turn? Trying to, let's say you're a singer or you're an actor and you decide to launch clothing brand or some bullshit product where people saw that like bad quality, bad reviews, no one liked it. You essentially ruin everything that you have built previously. Similar case with a lot of people who launched their crypto fake scam projects. They build up their career on something, right? Whatever, they got popular because they did like good analysis or predictions about the markets, people trusted them, and they essentially capitalized on it.
I spent the last 4 hours digging through the Wall Street expectations, predictions, and estimates for the crypto market. If you hold some crypto, I bet you want to hear this. And what I found out will shock you. First of all, 2
top firms on Wall Street, which have been the most accurate so far in their predictions, being on the bullish or bearish side. Alliance Bernstein, which had some correlation with Nancy Pelosi. And on the flip side, you had Standard Chartered. So both of them, their analysts are still seeing Bitcoin going to 150 up to $200,000 by the end of 2026. And according to them, regardless of who is going to be the new Fed chair, they said that the pro-crypto policy will eventually shift, that will get escalation when the Clarity Act is signed, when the banks cannot postpone, reduce, or limit on or off-chain yields. Remember, there are many projects that people are interested. They're buying into the project and they receive particular yield just by holding the coins of the project or staking it on this blockchain. So this is very important for developing of the DeFi space. This is something that has been a bottleneck for the reversal of the crypto, according to them, because there is a major unexplored market. Remember, we had NFT pushing the crypto cycle to new all-time high. Why? Because it was new unexplored market. We saw the same thing happening with the metaverse, right? As crazy as it sounds, the new unexplored market of the metaverse, selling real estate in the metaverse, having big companies like Adobe or Nvidia or Lego, they already purchased lands in the metaverse. So this actually pushed crypto back in the new all-time high cycle. So this is what is going to be. It's no longer the technical breakdowns. It's no longer the inflows or outflows of the ETFs. Second important point over here, Bitwise and Galaxy. Their prediction is breaking the 4-year cycle, something that I already mentioned in the previous videos. This is already dead, because if before the cycle was based on lack of adoption in the institutional side or on the government side, this is no longer the case. Government already created a Bitcoin National Reserve. Also, big institutional banks are offering their clients to purchase Bitcoin through the ETFs or Ethereum through the ETFs. Third important element over here is that a lot of these institutional investors, investment banks, have been staking up crypto on their own balance sheet. For what purpose, we still don't know. Also, the biggest banks have been building own blockchain systems using own cryptocurrency. So some people are saying they're building their own stable coins that are related to the bank themselves. So they're going to use it probably for transactions, some internal use. But this is a sign that DeFi and on-chain platforms and the whole ecosystem will eventually play out in real life. Second, Bitwise and Galaxy also see the connection in the volatility between the Mach 7, the technology stocks, the AI stocks, Nvidia, and the consolidation that is matching the sell-off in crypto. They're saying that effectively crypto is AI stocks without the AI. It's looking like Nasdaq without all the big technology companies. So effectively, the matching price action has been accelerated on crypto. If Nasdaq is down 3%, crypto will be down double, and vice versa, because the volatility has been evaporated at this point. Third main important element and metric Wall Street looks very closely. Remember, Wall Street is not throwing darts at the board. They're not guessing. It's no guessing over there. They're looking at the surveys. So the broader surveys Wall Street run show up that 74% of crypto holders still in Bitcoin, with experts like this in CoinDesk, right? They're viewing the current dip as cautiously constructive. What this even means? They're thinking that this is effectively a bull resumption setup. They're seeing that some of the OG crypto holders, the people who have had their wallets untouched for the last 10-15 years, some of them have been taking profits, but they just took profits from the top of their portfolio, 3 to 5 to 10% max. They didn't liquidate the entire crypto. What this even meant, that these people said, okay, the market looks like it's going to take a breather. The market's going to sell a little. I'm up substantially. I haven't cashed out for the last 15 years. Let me take some chips off the table. So these people took some chips off the table, and surprisingly, 2 days ago, someone actually sent to the original wallet of Satoshi Nakamoto 2.5 Bitcoins. And the speculator said, okay, this is the second wallet of Satoshi. He's transferring from one account to another, which makes no sense. But the main sense here is that when you have shift from one wallet to another, when you have active moves, there is 100% something coming up very soon. These people are not moving funds or crypto from one wallet to another, from exchanges or off exchanges, if there isn't a very strong action coming very, very soon. A lot of these people have been staying put for 10-15 years, so they have no issues staying and waiting much longer. But when you see some of them taking profits, a lot of the market actually use this as a negative catalyst to dump the market overall. Fourth important element here based on the surveys. According to this surveys, the sentiment and the views of investors who are still holding and who are still down, majority of which are down, institutions, investors, they're seeing and they assume that no major black swan event is coming around the corner. They are optimistic and bullish for the second half of 2026, and they're seeing this as a bigger breather for the market, which allow the market, remember, Bitcoin to hit these levels from current all-time high of 126 to 150, which is not so much, it's another $24,000, to the absolute top of 200, some people calling for 240,000. You understand, if the market wants to do the new all-time high of absolute peak of almost $250,000, it needs to dip more, right? You understand, the bigger the dip, the bigger the breather, the bigger the liquidations, the bigger the potential upside could be based on something known as elasticity, right? Think about elasticity. The longer it pulls, the faster it stretches and expands. So if you really believe in the surveys and if you really believe in Wall Street expectations and predictions, you should understand that these people have no better options to invest. If they believe that the AI bubble is very close to its peak, if they don't see better opportunity to invest, when you see that stocks are falling alongside gold and silver, and the new Fed chair will make the dollar great again, the only options for institutional investors still will remain crypto. When you consider treasuries likely won't be as attractive opportunities for institutions anymore. Let me know what you guys think about this. So in the last 48 hours, probably a lot of you missed my previous memo. Crypto recovered 14 to 15% versus the gold and the silver only 1.3%. Why is this? Well, like I said, if you missed the memo, you probably wonder why. Let me explain. In the last 48 hours, we had over $310 billion that was essentially bought off the dip on the crypto market, which inverted the patterns, and now the market will liquidate around $2 trillion in short positions. But why the gold and the silver didn't move? Why the recovery didn't appear the same way on gold and silver, where they're much cheaper? The gold is cheaper, the silver is cheaper. There was even greater dip earlier prior on the silver, around 40%. So this means that the people who are more bullish, people who are always bullish on precious metals as a safe haven, they didn't buy the dip this time. Why? Two possible scenarios. They either run out of money or they're extremely already concentrated in precious metals, meaning, we can speak whatever you want for diversification, for hedging, but you cannot just simply hold one or two separate assets. You need to have a very diversified portfolio, considering that the market is not yet decided. Are we going to go into the recession, or are we actually going to persevere? Pay very close attention to the numbers. And these numbers are already in the past, so this already happens. We're not speculating, okay? So in the last 48 hours, we had a sharp intraday recovery from the sharp dip in the crypto markets. Very importantly over here is that the strong rebound on the crypto market appear only on the crypto market. Sure, the stock market is closed on the weekend, but remember, the futures market is open.
This also indicates that on Monday morning, the gold and silver will have a chance to recoup the losses. Remember, I was talking about yesterday the levels of 5100 in gold. If the gold doesn't break the 5100 throughout the next trading week, well, gold most likely will be in trouble. And if the gold is in trouble, we don't really worry about silver, because silver will fall even more. The net recovery window, look at what is happening on the crypto market, was between 14 to 15%. And remember, people were calling out the end of crypto, the beginning of the cold bear cycle of crypto, which is not happening, because I mentioned last week that the 4-year cycle for crypto is no longer a thing. People are no longer following it because the Bitcoin and overall crypto market cap has become mainstream. You see Fidelity, you see Schwab, you see banks are offering clients to actually buy or invest in crypto. You also see the biggest asset managers, right, buying into the ETFs, Ethereum ETF, Bitcoin ETF, Solana ETF, AVAX ETF, right? This is very, very important. The current levels for the crypto recovery hover around 2.3 and 2.4 trillion dollars. It's very important because all these monies, as you probably understand, this is not the average Joe is buying the dip. This is institutional investors. This is Wall Street. So why Wall Street, instead of buying the silver dip, which if the biggest gap down 40%, if you're bullish, there is potential biggest gap up if you believe that it will go back up again. But they're not betting on this. Wonder why, right? Same thing with the gold, right? Why they're not betting that the gold will go back up, or why they don't hold on the previous price target, it's $10,000 by the year end. If we believe, think about it, if the gold now is around 5,000, 4,800, 600. But if you truly believe that the gold will go 10,000 by the year end, you're looking at crazy percentage upside. And if you truly believe, why Wall Street is not buying it? Because the likelihood of Bitcoin surpassing the previous all-time high are much lower, right? How likely is Bitcoin to surpass 121,000 in doubles to 240,000 versus the easiest goal for gold just to make it double from 5,000 to 10,000? It's much easier. But people are not betting on the easier part. People are betting on the more hard and complicated part, going from 70,000 Bitcoin, 72,000 to back to previous all-time high at 121,000, and then doubles to 250,000. Remember, Tom Lee from Fundstrat still holds his price target for this year between 240,000 and 250,000. We're not talking about Ethereum. I'm kind of bearish on Ethereum, so we're not gonna focus on this. Now let's look at the recovery process in the gold market. Let's look at the spot gold. So the experience dip that we saw on February 6th, which effectively was on Friday, hit lows of 4,600, lows of 4,600 as well. Very important is that the recovery was not that big, it was around 3 to 6%, but this particular dip, right, was not something that a lot of people were waiting to buy into. There was no interest, right? If you look at the charts, we saw that there were a couple of green candles, but there was more than red ones. And we saw that we failed to break the previous highs, or at least to reach the previous highs. Remember what I mentioned? If we couldn't hit the previous highs going up, make a lower high from the previous high, the likelihood is that we're gonna go lower. And next time when it goes up, it's gonna go even lower than the previous high, and then it's gonna go lower high, lower low. This is what Wall Street expects. And if they see this weakness, like I said, gold has next week to break the 5100. If it doesn't, most likely the Wall Street will set up the computers and the alternative trading systems, ATS, the computer trading, the algorithm trading, to most likely flush the prices. Remember, there are a couple of important levels of support that you want to look at: the gold 41, 4200, and then if it goes below that, we're looking at 3800, possibly 3400 if we're having a major, I would say, rotation. This is a very important term on the markets. So we didn't see the recovery that people were expecting. We didn't see people buying the dip as we expected. And if we move to silver, things are looking a little more uglier. Lower interest, right? Spot prices, again, much lower, greater dips. We saw 7
and 10% sell-off on the silver market. But the reversal was not there. Lower volatility, lower interest, 48 hours recovery was partial, very partial performance, similar to the crypto markets, but with a lower volume, much less lower leverage positions, which, as you're probably aware, when you see a lot of leverage, this means individual investors, because they place a small capital, right, and they borrow against a small capital so they can have larger positions, so they will be able to capitalize on the small price moves. Big investors, they don't use leverage, they just have a lot of capital that they can operate with, because it is expensive to borrow. And remember, when you borrow, when you trade on leverage, a small moves, sometimes 0.5% can liquidate you. I'm talking about absolutely everything to go bust. This is why when you're big institutional investors, you want to make sure you have room for mistakes, you have room for errors. So if the market goes against you, you're not going to lose your investors' funds. Where individual investors, right, they don't have much to lose, especially if they trade with some international overseas brokers where they allow them 100x, 500x, crazy leverage. Don't do this at home, kids. So that's what I'm seeing over here. We're having a sharp reversal on the crypto market, and again, seems like the worst is already in the past. I don't know why there is a slowdown on the precious metals market, considering the negative beta I've been talking about. So a lot of people saw that the main function for which they're buying gold and silver doesn't function. It's no longer hedge. It's no longer negative beta. When the market crashes, gold and silver crash as well. So why would I buy gold and silver when they crash as well, and they crash even harder? If I had S&P 500 on Friday sell-off, I will be down 1.7%. If I had the gold, I will be down 8%. If I had the silver, I will be down 12 to 15%, right? What's the point? There's no point. Also, let's not talk about how illiquid some of these spots could be, and let's not talk about how the volatility disappears overnight sometimes. When the market decides that, you know what, they don't actually fulfill the need I had for hedging. So be very, very careful. So guys, this is my last warning. The most bearish plausible scenario that the market is preparing for is that the nominated for Fed Chair Kevin Walsh marks the top of the bubble in gold and silver, leading to multi-quarter correction driven by tighter than expected policy. Leading to multi-quarter driven correction. Do you understand this? Second, third, fourth quarter, lower highs, lower lows, lower highs, lower lows. This is what the market is preparing for. This is the most bearish scenario. Also, they're expecting a very strong dollar on top of the liquidations of the long positions in the precious metals. What the Welsh nominations actually means for the market? Well, Wall Street is preparing for the market quickly reprice the very, very bearish on the stocks in crypto and reprice very bullish on silver, gold and other precious metals. There will be a completely 180 degrees reversal on the sentiment, and the current hedges that people explore precious metals as hedges will no longer be the case. The debasement trade will be over. What this even means, not only for America, but also for European Union and BRICS, it's a checkmate. When the dollar becomes again the most powerful currency, when the gold is no longer needed for hedging, well then all the leverages of other countries simply disappeared overnight. The dollar has already bounced on the news today, has already become more and more stronger against the euro. This particular part of the reversal is the first indicator that we're having found the pattern of the dollar and there is a new pattern building towards the previous highs. Wall Street also expects that after the new chair steps in, dollar is not only going to reverse, but will again become
dominant power and build the new year-long highs. This will be a major tailwind for the metals. A more independent and less politicized Fed means that the Federal Reserve will be allowed to make decisions, right? But remember, Donald Trump is selecting this person. So again, the decisions still will be more or less discussed prior announcing. Price action and technical bear case for the gold. Today, gold had one of the worst single-day drops in decades. This is not just today. Looking at the price action, for the last 12 years, the gold hasn't seen a single day drop between 10 and 12%. This means that we had hit the inflection point of volatility of gold. So far, the gold was making a moves, but was not as volatile. This 10-12% and around 30-40% in silver indicated a completely break-even point where things are already inflexing on the opposite side. Even after 60-70% gain over the past year, which is a classic blow-off top reversal pattern, there is still chance for even greater sell-offs than the previous very strong consolidation that happened throughout the last 3-4 years. Which means that people who are currently up maybe $300, $500, $600 and they're happy and they're looking forward for the long run. I went on Reddit, I sneak on Reddit group for gold to see how people are actually replying to this particular price. Actually, people said, I'm not worrying about. I'm buying for the long run. Which long run, my friend? Second problem over here, the silver. After the new chair steps in, silver will experience greater sell-offs than the current one we saw. So far, silver has been more extremely hurt, 30-40% a day. This is again single day major declines in decades.